Hi, good morning, everyone. Thank you so much for joining our Phillip Security Research 11 o'clock Monday morning call. So today we will continue to present earnings results. For the US, we actually have AMD, Airbnb, Apple, and Amazon, while in Singapore we have DBS, UOB, SGX, Lendlease Global Commercial, Sembcorp Industrial, and Venture, plus the Phillip on the ground for YZJ Shipbuilding and Riverstone, as well as our technical polls. For disclaimer, the information provided in this seminar is solely for educational purpose and it should not be considered as a financial advice. So please seek any advice for the financial advisor before you make any investment decision. And with that, I'll pass the time to Iqbal. Thanks very much.
Thanks, Serena. I'll be presenting on AMD's second quarter results. Our report titled Multiple Engines for Growth. Next slide. Yeah, so for AMD's second quarter results, their revenue is within our expectations. Their PATMI exceeded our expectations because there's a lower than expected impact from the China chip ban. For their positive wise, for their data center segment, their EPYC CPU drove demand, a lot of demand for their data center segment, and their MI355 GPU chips also started shipments in June, so this is expected to ramp in the second half of this year itself. As for their client PC and gaming segment, they continue to gain market share against Intel because of the very strong demand for their Ryzen CPU chips. As you can see in the chart in the bottom left-hand corner, for the most recent second quarter client and gaming revenue itself, it is actually the highest compared. It has the highest revenue since first quarter 2023 itself. Yeah, so this shows that the uptrend in terms of demand, in terms of gaining market share against Intel. And one example would be Dell, including AMD chips in their commercial PC portfolio. Yeah. As for their gaming segment, there's also strong demand for their Radeon 9000 series gaming GPU because inventories normalize and their major customers start preparing for the holiday season. For example, Microsoft in their Xbox. As for guidance-wise, AMD guided 28% year-on-year increase for the third quarter revenue, and this excludes the potential MI308 chip revenue to China. And AMD also mentioned that it takes a couple of quarters to sell through the MI308 inventory upon being granted the license by the US government. Because currently their inventory is mostly still work in progress, so they still need a couple of quarters to assemble everything before being able to sell to China. As for their data center segment, we believe that it will continue to benefit from higher capex for guidance by the hyperscalers in their most recent quarter earnings. For example, their MI355 GPU chips is comparable in performance compared to NVIDIA's Blackwell itself. Yeah, so we do think that the higher capex guidance by hyperscalers will eventually will be used to purchase AMD's MI355 chips. As for their client PC segment, we do think that this strong uptrend momentum will continue. It will continue to gain market share against Intel. And we do think that the current PC segment will also benefit from the Windows 10 end of service in October this year itself. Yeah, so we do think that a lot of enterprises will switch out their very old PCs to AI PCs, which has more memory capabilities to run your AI models, for example, ChatGPT. And another thing that we think will benefit AMD is that the US government unveiled the AI Action Plan. Yeah, so this is basically a government initiative whereby they encourage domestic demand and manufacturing for AI data centers as well as the cloud servers. So we do think that TSMC, being a very big supplier for AMD itself, and them pledging a very big investments in US soil itself, will mitigate them from the tariff impacts, because Trump introduced the 100% semicon tariff last week, and but the clause is that he excludes companies that pledge a very big investment in US soil itself. Yeah, so we do think that this AI action plan will benefit AMD. As for our call, we maintain accumulate. We raise our target price from 120 to 190. And because we raised our this year's revenue and PATMI assumptions because of expected MI355 GPU RAM, as well as the strength in client PC and gaming segments, as well as potential upside from the MI308 chips to China. And we also reduced our WACC to 7.5% from previous 7.9% because of the US government's reversal of the MI308 chip ban. Yeah, that's all from my end. I'll hand over the time now to Fahmi. Thanks.
Hello, good afternoon, everyone. I will present on Airbnb, the online travel companies, for the second quarter 2025 result. Next slide, please. So Airbnb released a result last week on the second quarter 2025 financial year. So the result was within our expectation. The revenue and the PATMI was 44% and 30% of their financial year 2025 estimates. So you see that the revenue and the PATMI is not at 50%. That's because Airbnb business is cyclical in nature. So it's depend on the travel demands. So you don't see that travel demands consistent over the years. So we would see higher travel demands and earnings in the remaining quarters, especially during the summer season, which is right now, which would affect this quarter's earnings. And so we expect PATMI to be loaded. So jump straight to the positive points. First is that travel demand has stabilized. Revenue grew by 13% year-over-year to 3.1 billion. So these numbers beat the top end guidance last quarter of 3.05 billion. And this was fueled by mainly three things. First is a steady booking volume growth of 7% year-over-year, a slight increase in average daily rate of 3% to $174, and the timing of the Easter celebration. So, and furthermore, despite the global economic uncertainty that happened last quarter, which resulted from Trump tariff, travel demand has picked up recently. So, especially for the North America, which accounts for approximately 30% of the total night book, which was also the main concern last quarter, because the United States mainly will be impacted for the consumers there. So, but then again, North America has improved in this quarter, second quarter, with the United States booking goal. Management guided that the United States booking growth has accelerated slightly, driven by domestic travel. So the concern was that when tariff would be imposed to the outside countries, that would impact the United States consumer. But management guided that last quarter that most of the United States booking night actually came from the domestic travel instead of the outbound travel, because outbound travel actually for the United States only make up about 2 to 3% of their total night book globally, actually, so it's not that big to impact. So yeah, travel demand has stabilized. So second positive point is that market growth continued to accelerate. So night book in expansion market, for example, for Latin America and Asia Pacific, grew nearly twice as fast as in core markets, and this is for the 6th consecutive quarter. And again, this is led by the regions with the strongest demand, which we are seeing from Latin America and Asia Pacific. So Latin America saw about high teens year-over-year growth in booking night, with first-timer bookers grew about 20% in this quarter. So this is fueled by the product localization efforts. For example, one country that Airbnb highlighted is Brazil. So they highlighted that the first-timer bookers also growing at the 20s, low 20s growth year-over-year, with for example, with the introduction of the local payment system. So because even gets included us that if when you travel and you have the Airbnb itself has the local payment system, is actually make it easier for people to book, and people do want to book when you have the local payment system. And looking at the other side of Asia Pacific, which is also one of the expansion markets for Airbnb, Asia Pacific posts about mid-teens year-over-year booking growth, and this is led by Japan's domestic first-timer booker rising about 15% year-over-year, and this is supported by the domestic brand campaign that they have been doing about since last year. And the negative point is that we would be seeing continued pressures on the third quarter 2025 margin. By that, I mean the adjusted EBITDA margin. So Airbnb anticipates that some pressure on the adjusted EBITDA margin, which would result in slower earnings growth. And this would be resulted from higher spendings because of the continued investment of their new business, right? Their new Airbnb services and their relaunch Airbnb experience. For example, because if you look at the left side, we see that product development and the sales costs increase about 20% year over year. And this is actually higher than the usual increment for their expenses. So some of the expenses that happened last quarter is because they use their expenses because of the new growth and the policy initiative for the new business. And looking at the outlook for the third quarter 2025, we expect demand trend to continue to be encouraging, with night and seats book continue to accelerate sequentially across several countries, including Canada, Germany, and Japan. Booking volume is expected to remain stable at 7% year over year. ADR is expected to rise modestly, and we expect earnings growth to remain limited in the both third quarter and fourth quarter, and this is because reflect the higher expenses tied to the ramp up of the new business. So we believe that travel demand has stabilized and regaining momentum after the earlier softness seen during last quarter because of the Trump tariff policies. Airbnb guided that some improvement in the current quarter from April to July. And we also see, if you read the news, that some of the US airlines and online travel companies such as Booking Holdings and Expedia Group also among those that have slightly raised their guidance for the current quarter. And they say that this is supported by the noticeable rebound in the travel activity since last quarter, also including this recent July. So particularly in the US market, they see some consumers started to spend higher in traveling. So some of the points that the new business at Airbnb is currently launching and has been going for about 4 months, 2 to 3 months, which is Airbnb services and relaunching experience. But we think it's still in the early development, are expected to contribute meaningfully starting next year, which is 2026. We see that Airbnb is currently focused on building traction instead of monetization. Airbnb emphasized some numbers, but it's not actually some like the earnings numbers. It's more like they are emphasizing on the early momentum, which, for example, they are saying that guest rating is averaging over 4.9 out of 5 star, and more than 60,000 host applications has submitted some of the applications since the launch, meaning to show interest from the host to participate within these Airbnb services. That's about it, I think. So the conclusion is that we upgrade our to neutral from reduced recommendation following the recent price performance, and we also raised our target price to 127, which was previously 112. While our 2025 earnings revenue estimate remained unchanged. We maintained 7% for WACC, but we raised our terminal growth from 3% to 3.5% to reflect the stabilizing travel demand. Right. That is all from me. Now I will pass to Helena for Apple presentation.
Thank you, Fahmi. So I'll continue with Apple. So overall for Apple's third quarter is a good set of results, but we're still remaining cautious. So this third quarter result were within our expectation. The 9 months FY25 revenue and PATMI were at 75% and 76% of our FY25 forecast. Revenue actually grew 10% year on year, which is considered really decent for Apple. It's mainly driven by the growth in iPhone, which grew 14% year on year, and services, which grew 13% year on year. So jump straight to the positives. The first, their services segment still remain their key growth driver. Double-digit growth is the 7th quarter of double-digit growth. And we do expect them to continue boosting profitability further because they have a much higher margin compared to their product segment. We do, however, closely monitor 2 potential risks that can decrease its share of revenue. One is their potential App Store payment changes. The other one is the loss of Google search fees due to Google's legal actions. So both right now it's unlikely to happen, but if it does happen, they're gonna have the effect of around 5% and 20% of Apple's service revenue respectively. So that's something we're gonna be continuing monitoring. And the second positive point is they have the strongest iPhone growth in 15 quarters. It rose 14% year on year. The surge was driven by a few reasons. The first is they see a popularity in the iPhone 16 lineup, which is much more popular than iPhone 15. The second is the tariff-related pull forward effect. People saw that the price is going to increase, so they tried to purchase the iPhone beforehand. But Apple said it only contributed to around 1% of the revenue growth. And last reason is they have increased sales in China. This is supported by a government subsidy by China. Which I'll discuss more detail in the next point, which is it's their first growth in China in the 8th quarter. This is because their government has offered a 15% discount on smartphones. So as a result, the China revenue grew 4.4% year on year, and iPhone 16 sales grew 8% year on year. So this program was not just targeted to Apple phones, it was targeted to the entire China smartphone, but it's expected to be tapered off later this year. It has actually benefited the local brands more because when the policy came out, there was an eligibility cap. So there was like a certain cap. They only matches to the cheaper end of the phones. But iPhone is too expensive, which is why they were not part of the campaign in the beginning. But then Apple starts seeing that the other companies reaping a lot of benefit from that. So they tried to cut their iPhone 16 and 16e prices in order to meet the eligibility cap, which is a little bit more than $800. And because of that, they managed to boost their sales. But it affected the local brands more. Xiaomi's phone increased 40% year on year, while Huawei increased 18% year on year. So overall, smartphone sales in China grew 5% year on year. Moving on to the negative, we still think the new tariff is a significant risk and headwind. So Apple reported $800 million in their tariff-related costs for this quarter, and they expect an additional $1.1 billion for the next quarter. And because they have no plan right now to adjust their prices on the current models, so it's likely that they're going to absorb the higher production costs, which is going to compress their gross margin by about 140 BPS. In terms of guidance, Apple expected next quarter revenue to increase by mid to high single digit, and they expect services to continue growing at a double-digit rate, similar to right now, which is 14%. So we estimate, just from simple math, their product growth is going to be single digit. They're also guiding for their gross margin to be 46 to 47% and an operating expenditure of 15.6 to 15.8 billion. Overall, we still maintain a really cautious view on Apple because near-term tariff headwind is continuing to weigh on their margin. And even though their iPhone sales and China market performance were strong this quarter, we expect the momentum to fade because the China subsidy program, there's a temporary nature of it. And also with the delayed Siri rollout, it was delayed to FY26. There was really just no major new iPhone features to actually drive the fourth quarter growth. Their guidance, we can also tell, it kind of indicated that the iPhone growth is going to be softer compared to this quarter. So overall, we keep our FY25 revenue and PAMI assumption unchanged. We maintain our recommendation of neutral with the DCF target price of $200. So that's all for Apple. I'll move on to Amazon. So Amazon, it was a decent quarter. Their growth prospect is still intact. So the second quarter revenue and PAMI were in line with expectation. Their first half 25 revenue and PAMI were at 46 and 55 of our FY25 forecast. The primary revenue driver for them still remain AWS, which grew 18% year on year, and advertising, which grew 23% year on year. AWS operating margin actually compressed 2.9% year on year to 32.9%. This is due to very heavy AI investment. But retail margin surprisingly increased 0.9% due to efficiency improvement. So for the positive part, we think the retail margin expansion is actually a pleasant surprise because with the huge macroeconomic backdrop, like people kind of expect that their retail margin is going to compress. So retail revenue actually grew 12.4% year-on-year, marking its strongest growth in 5 quarters. Management noted that they actually haven't really seen a decrease in demand. They're seeing pretty steady demand and no increase in ASP as well in the first half of FY25. And the growth is driven by their operational efficiencies in fulfillment. They have faster delivery speed, they have more direct link shipment, and they have less average delivery distance. So all this has helped in their efficiency. They also have new brand launches like Nike and Marc Jacobs. And they also try to expand into services like groceries and pharmacies more. So overall margin expanded 0.9% because of their efficiency enhancement. So we look at their retail segment, we do expect them to remain the leading e-commerce outperformer despite the tariff coming in, because they're supported by the industry lowest pricing. They also have a very sticky consumer base, and also because they have such a broad seller network compared to their competitors. So some of the sellers, they will choose to absorb the additional price. So that's going to be a win for them. The second point is we see their advertising as a pretty promising sector. So their growth remained robust. It grew 23% year-on-year, primarily driven by sponsored product with higher ad relevance. They recently started adopting their Amazon DSP platform, as well as they have this partnership with Roku, which kind of give advertisers access to connected TV households as well. So all these has been driving up their ROI for advertisers. We believe advertising remain there's a huge growth opportunity there because it can scale alongside with its retail business. And right now it's a very small fraction of their revenue. It's only around 9%. So a lot of growth space there. So moving on to the negative, like I mentioned just now, we had a margin decline in AWS. So AWS, actually the growth was still pretty strong. It grew 18% year-on-year, but margin fell 2.7% to 32.9%. So that's what kind of shocked the market because it's the lowest in the last 6 quarters. Because of heavy AI investment. So if we look at their capex spending, it reached $31 billion, which exceeded their $26 billion guidance. But it's actually pretty normal because Amazon has been trying to warn people for several quarters that margin is going to fluctuate because of the nature of how they invest in AI. It's going to be like different timing that they actually pay that much money. So Amazon, they're trying to build a long-term AI driven cash flow boat. So somewhere along the line, it's going to fluctuate. But we do see AWS is losing market share to its rivals. In terms of the cloud industry. Right now, they're still the market leader. They have 30% market share, but compared to Azure and Google Cloud, whose growth speed is much faster, they grew at 32% and 39% year-on-year respectively. But nonetheless, we're still seeing really strong consumer demand for AWS. Their backlog grew 25% year-on-year. And we do expect to see long-term growth right now because the cloud industry right now is so not saturated. It's just in a very fast developing stage where all the players kind of get a bigger slice of the pie. So we do expect to see long-term growth. And transition to cloud is still in very early stage. So still a lot of potential there. And in terms of guidance, Amazon guided their next quarter revenue to be 10 to 13% year-on-year growth, and their next operating income to be between 15.5 billion to 20.5 billion US dollar. Their capex is expected to remain around the same, which is 31 billion per quarter. We continue to see strong momentum in both retail and AWS, although tariff uncertainty is going to pressure their e-commerce margin. But given their scale, their sourcing flexibility, we think they're well positioned to manage these risks. And Amazon, like I mentioned just now, their demand still remain very robust. The entire industry is rapidly expanding, so all the players are benefiting from the growth. So we do see they're going to maintain the growth, but however, the dynamic could shift as the market matures. But that's going to be like a long-term thing, probably like 5 to 10 years, because right now more than 85% of the IT spend still remain on-premise. So still a long way to go. Overall, we maintain our FY25 revenue and PME assumption. We didn't change anything. Though we maintain our DCF target price of $260 and we maintain a buy recommendation. So that's all from me. I'll pass my time to Glenn.
And yeah, so we'll just be going the banks. So all banks have released their results now. Starting with DBS. DBS earnings were really the only one that were in line with our estimates, and also I guess in line with the consensus estimates as well. So their second quarter earnings were in line with our estimates, and the first half was at 50%, so almost exactly on the dot. Their dividends were raised 39% year-on-year to 75 cents. So this comprises 60 cents of the ordinary dividend and 15 cents of the capital return dividend. So it's quite in line with what we were expecting and what they have also said. For the positives, the biggest positive is that I think they're the only Singapore bank that actually managed to increase the net interest income. So it rose by 2% year-on-year, despite the group NIM dipping by 9 basis points. And the main reason why they managed to do that is from the deposit growth of 7% year-on-year. So the NIM fell really from the rate cuts as well as the lower Singapore and Hong Kong interest rates. The reason how they managed to maintain their positive increase in their net interest income was because the deposit growth was led by CASA, or current account savings accounts, and it was up 8%, and the CASA ratio also improved to 52% from 50% a year ago. So they earn around a 1% margin on this, so it will compress the net interest margins a bit. But if you look at the overall picture, the base is growing, so there is more net interest income, but margins will dip slightly. So that's what they are also anticipating for the rest of the year. And for the second positive is that non-interest income has also supported earnings somewhat. Total non-interest income rose by 11% year-on-year, mainly coming from the wealth management fees, which grew 25%, and also the trading income, which surged by 124% from the higher volatility during the quarter. Lastly, the allowances also declined, really from a GP write-back. So they had a GP write-back of 17 million compared to a GP of 51 million a year ago. So that's what moved the allowances down. They also still have at least maintained their management overlay of 2.6 billion, and this is a very huge amount that they have been holding on to, or they've been building up and holding on to since COVID times. So they haven't really let go most of it, and it was mentioned that this will really act as a buffer for GP write-backs if the specific provisions come in higher than expected. The one only negative that we can see is that the expenses have continued to rise. It was higher really from higher staff costs. But if you look at the cost to income ratio, it was stable at 40%. As for the outlook, they have maintained their guidance. I think they're the only bank again to not change guidance, right? They maintained it and indicated that net interest income will come in slightly above 2024 levels, really from the strong deposit growth that they are seeing. Cost to income at the current levels of low 40%, and the specific provisions to normalize around 17 to 20 basis points. And again, with the GP overlays that will help to provide this buffer if the specific provisions come in higher than expected. And so overall, the PATMI will still decline from the 2024 levels, but only due to this global minimum tax of 15% that they are more prone to as compared to the other two banks. If I get a question of the reasoning why DBS gets this global minimum tax of 15% is because they are more global bank, so they have a lot more assets and a lot more revenue coming in from other countries, which pay a lesser tax than this 15%. In FY24, they only paid around 12.2% average, whereas the other banks are really very near that 15% mark. So they don't really have any impact from this global minimum tax of 15%. Another driver will be the non-interest income. So we'll be looking at wealth management fees and treasury customer sales, which will lead the way, and also that the heightened volatility will benefit their trading income. We maintain our accumulate recommendation with a higher target price of $52, mainly from lowering the beta for DBS to 1.1. Is really to reflect DBS's more defensive earnings profile, strong capital position, as well as the relatively lower sensitivity to market volatility compared to their peers. We expect that non-interest income will be the main growth driver, as the heightened volatility will benefit the trading income and also the continued wealth management growth. And their net interest income will inch up slightly and will be supported by the huge deposit growth that they are being able to benefit from. But then again, the higher provisions as well as the global minimum tax will hurt PATMI in FY25, and we'll see a slight dip. We do prefer DBS, and it's our pick amongst the 3 Singapore banks, mainly for its fixed dividend per share policy. So the other 2 have a floating and semi-floating policy, and so it's easier to predict for DBS, how much dividends you're going to be getting, and if earnings dip, you will still be getting this set of dividends. So they have also extended their ordinary dividend, the ordinary step-up dividend that they did mention about 2 years ago, that they will give this 24 cents step up every year, which will start in the 4th quarter. So they said that for 2026 they will be continuing, or at least it'll be very highly likely that they will be continuing with this step up of 24 cents. Yeah. So that's for DBS. Now let me move on to UOB. Yeah, so for UOB, it was a bit of a disappointment, right? Their net interest income and allowances did pull down their earnings, and their 2nd quarter earnings did fall below our estimates, mainly from this lower NII as well as the higher provisions. Their first half PATMI was at 47% of our forecast. Their interim dividend, as I just mentioned, right? Some of the other 2 banks have this floating policy of dividend payouts. So because the earnings fell, right, interim dividend did also fall by around 3% year-on-year to 85 cents. But they maintain their dividend payout ratio at 50%. For the positive, there's really only one, which is the non-interest income did grow by around 5% year-on-year, but it was slightly lower than what we were expecting. The growth really came from wealth management, loan-related services, and also credit card fees. The reason why it came in lower than expected is because a lot of their customers are more, I would say, prudent, and they're safer. So a lot of the wealth management AUM that came in didn't really go into investment products, right? So investment products have a much higher margin. But for UOB customers, they rather stay safer. So I think you mentioned around 50 to 60% of their AUM is still stuck in fixed deposit, right? They're happy to take that 2% fixed deposit instead of investing it, because it's quite volatile now, and the market is very volatile, so they are not willing to take that risk. So they are quite low risk, hence they were hit a bit slightly by this lower than expected wealth management growth. For the negative, the net interest income has continued to decline. It fell by 3% year-on-year from the NIM compression of 14 basis points, as their asset yields decline faster than their funding costs. And unlike DBS, they didn't have this huge windfall of deposits growth, so they weren't able to capitulate on this deposit growth. Their exit NIM for 2nd quarter was 1.84%, but UOB is guiding for to end the year with 1.85 to 1.95% of NIM. So how they are expecting it to recover slightly, mainly from the reduction in funding costs, as they have. If you are a UOB One account user, you definitely know it or feel the pinch where they cut their interest rates, I think twice within the last few months. So this will be expected to flow through mostly in the 3rd quarter, and possibly some in the 4th quarter as well. Another negative would be their allowances did rise from higher specific provisions. There was not really a single account that caused this rise. It's really quite broad-based. And also their NPL ratio did inch up slightly to 1.6%. As for the outlook, their guidance, they have lowered their guidance, but just to put a caveat there, they lowered it from the previous guidance that they gave in the 4th quarter. Because 1st quarter, they paused their guidance, and then they gave guidance again in the 2nd quarter results. So based on the 4th quarter, what they have told us, and the 2nd quarter now, they did lower it to the NIM guidance to 1.85 to 1.9% from 2% previously. And they were citing, that the interest rates decline hit them harder than expected. Hence, that's why they're giving this lower guidance of the interest margins. The rest of the guidance is quite similar: low single-digit loans growth, high single-digit fee income, as well as credit costs quite stable, around 25 to 30 basis points. However, another thing that they mentioned is that they have reaffirmed their plan to return the 3 billion. So it's 1 billion in dividends and then 2 billion in share buyback, but that they will maintain their 50% dividend payout ratio guidance, even if the absolute DPS or dividends per share declines year on year. So, we are expecting earnings to dip by around 4% year on year. So that will mean, if they maintain it stable at 50%, you will see their dividend per share actually decline slightly, because it's based on the 50% earnings, right? So 50% of earnings, if earnings decline, dividends will decline as well. And it was asked if that happens, will they increase their dividend payout ratio, because they have the capacity to do so. But UOB was quite adamant, saying that they have maintained this dividend payout ratio policy for the longest time, so they will not be looking to change it anytime soon. So I think we will be sort of expecting dividends to dip at year end. So but a positive and outlook for them would be that we expect fee income to continue to recover, especially in their ASEAN region, because they have successfully integrated their city portfolio in all four of their in the ASEAN countries: Malaysia, Indonesia, Thailand, and Vietnam. And also this could further expand their regional franchise, and they are working very hard in trying to grow that outside of Singapore. As such, we downgrade to a neutral from an accumulate recommendation with a lower target price of $34.60 as we lower their earnings by 4%. We expect that earnings will decline by 4% year on year, mainly from the decline in the net interest income, but that the NIM compression will ease slightly in the second half as the funding costs improve from the flow through from the deposit rate cuts, and that the fee income will be the most significant driver from the successful integration of their city portfolios in ASEAN, and that it will accelerate their expansion further into the region. So that's all for DBS. Now let me go to my last counter, which is SGX. So SGX released their second half FY25 earnings, and the revenue and earnings did come in slightly below our estimates, at 97% and 92% respectively. This variance really came from lower than expected FICC as well as treasury income. The key highlight, I think, for SGX's results was the dividends. They increased dividends for the second half by 11% year on year to 19.5 cents. So the FY25 total DPS is now at 37.5 cents, which is up 9% year on year. And the main highlight is that they have announced quite a firm dividend policy. I think they are taking a page from DBS, where they are giving absolute dollar DPS guidance instead, and that they will increase their DPS by 0.25 cents per every quarter for 3 years. So from FY26, FY27, and FY28. More on that later. I'll jump straight to the positives. Firstly is that their currency and commodities have pulled up their FICC revenue. So this currency and commodities was up 13% year on year, mainly led by the currency derivatives volume surging by 50%, as well as the commodity derivatives volume rising by around 6% year on year. Their OTC FX have also continued to surge. The revenues have risen by 25% year on year, and SGX is now guiding for the OTC FX to have mid to high single-digit % contribution to EBITDA in the medium term. Currently, it's around 5%. The SDAV and derivatives volumes have also continued to recover, and mainly from the higher volatility as well as the elevated investor interest. So SDAV rose by 22% year on year, while the while the derivatives volumes grew by 12%, really from this higher market volatility. And the last positive, and I think the biggest one that investors are most interested in, would be this quarterly dividend increase. As I said earlier, they're giving this 0.25 cents per quarter increase for the next 3 years. So it will be from until FY28. And if you look at it on a whole, what does this mean? It means for FY26, it will be a 19% year-on-year increase. And then FY27 will be a 9% increase. And then FY28 will be an 8% increase. So I think there was quite a cheeky question asked during the briefing, if this was the baseline or the cap, right? And so good news is that management said that this was the baseline for dividends increase. So it's like the minimum increase that they'll be giving is 0.25 cents, right? And that there's a possibility to return more if the earnings come in higher than expected. And we believe that there is an upside surprise to dividends and a chance to for SGX to further increase it if they actually increase their dividend payout ratio. So if you look at it currently, now the dividend ratio has actually not changed. Dividend payout ratio has not changed, although they raised their dividends. It's because from the earnings increase, so they're basing it still on this, I think, 60+%. So if they were to increase it to a 70% payout ratio per se, we could actually see this year's dividends rising by 22% instead to 42 cents. Yeah, so I think the dividend payout ratio is, if they follow that and say that we will pay more when we are earning more, then it'll be quite a big upside. The biggest negative, I guess, and the only negative would be that their treasury income has fallen quite sharply. So this treasury income is basically interest on what they earn from the collateral balances that they hold, right? So if you have money there, they have the whole collateral balances, and what they do is that they put this huge sum of around, I think they currently have 11 billion now, right? They will put it into fixed deposits all over the world, right? It can be any country. So that's how they earn their interest income. And with rates falling quite sharply across the world, except for Japan, right? We see that they are actually getting lower average yields on their margin deposits, which is why this treasury income has fallen by 17% year on year to 57 million. And also, if you look at the contribution has also dipped from 18% a year ago to 15% currently. And we do expect that treasury income will continue to decline as rate cuts are expected in the second half of the year. As for the outlook, we believe that volumes will continue to recover, and the second half has recovered quite strongly. And the heightened volatility has supported this, and the July figures that we have seen for the SDAV figures are also quite positive. Yes, actually July SDAV has risen by 26% year on year. The OTC FX business is also growing quite steadily. They have achieved their target of the ADV of 100 billion USD quite early, and now I think they haven't given a new target for this, but now they are trying to see if they can have more contribution from the OTC FX. Lastly, for their guidance, they have given two figures, right? Mainly the expense growth of 4 to 6% for FY26, as well as capex of 90 to 95 million for FY26. So these are really for the build out of their OTC FX business, and also higher staff costs, which mainly due to salary increments. So we do maintain and accumulate with a higher target price of $16.90, but we lower our FY26 earnings by 10%. And but the target, we raise our the PEG, so our target price is now pegged to a +2 standard deviation or 26 times PE. From previously we were using the mean of 5-year mean or 21 times PE. So we expect SGX will maintain stable growth from their OTC FX business pillars, as well as their currency derivatives volumes, and benefit from operating leverage. The heightened volatility surrounding the President Trump and the US trade war will sort of boost volumes, and also Singapore's standing as the flight to safety venue in Asia will also help. And the falling interest rates, however, do remain a headwind as treasury income will decline further from the rate cuts. So that's all I have for the finance sector. I'll hand it over to Miao for Yang Zhejiang. Thank you.
So Yang Zhejiang released the first half 25 result last week. Next slide, please. Yeah, so this is a Phillip on the ground. We don't cover Yang Zhejiang, and yeah, so it's non-rated. Currently they have a market cap of 11.4 billion, mainly doing shipbuilding and marine engineering. And in the first 7 months of 2025, they secured 0.72 billion in the new orders, achieving 12% of the annual target of 6 billion. However, they are revising down the target order wing from 6 billion to 4.5 billion, mainly because they halted the Rinzhou project, on the large vessel delivery for 2028 or 2029. So we believe the order book apparently it has already peaked, and the industry new building price is easing, and competition has already shifted from international, which was previously among Koreans and the Japanese shipyard, to more of the domestic Chinese player, Chinese competitions. Yang Zhejiang also delivered a pretty strong set of results in first half. Profit surging 37% year on year, and they also recorded record profit margin increased by 7.5 percentage point year-on-year. And we believe there is and for outlook, we believe Yangzijiang there's like still further margin upside in second half 25 due to RMB depreciating on the back of the highlighted geopolitical tension and also US tariff related uncertainties, which will weigh down RMB. And they're still pretty ship owners are still is turning more optimistic towards the outlook, especially about the USTR 301. And Yangzijiang has already purchased like the steel for 2025. Which removes the uncertainty for its margins as like steel accounts for more than 30% of the total cost. However, for the long term, margin, even though margin appears to be strong now, this is mainly like backward looking, reflecting historical contracts signed at a higher price and also lower steel cost. And the current focus is more on small to mid-sized vessels, which typically has lower margin. So we are worried about future margins. And they are currently focusing on building the small to mid-sized vessel delivery for its Hongyuan project. And also REIT has been shut it down. And they're trading at forward dividend yield of 4%. Its dividend policy remains unchanged at 30 to 40%. Next slide, please. REIT deliver a pretty strong set of FY25 results, mainly because they managed to divest the GEM office. DPU in FY25 declined by 6.9% year-on-year. And for something positive is they achieved pretty strong rental reversion of 10.2% for its retail asset in Singapore and 1.7% for Sky Complex in Milan. And moving forward, we expect rental reversion to moderate to mid to high single digit, which will be supported by muted new supply and also sustained occupier demand. And for its recent GEM divestment, they managed to divest GEM office at valuation for 462 million. And this resulted in an 8.9 million divestment gain, which is distributable to unit holder. And there's also 2.2% DPU dilution, since cost of debt is lower than NPI yield of 4%. And currently gearing stood at 42%, and we believe this will trend down after they use a substantial amount of the proceeds to pay down its debt. And we are looking at around like 35%. And also potentially 15 million saving in its finance costs, which will be their DPU upside in FY26. And also due to SORA on the declining trajectory, we expect all-in cost of borrowing to decline to around 3.2%, which is another like 20 basis point saving in FY26. And for outlook, due to the income vacuum, we expect some like acquisition in the upcoming year, which target is a potential target will be PLQ Mall, its retail site. And there's also ongoing AEI to connect the mall into the new MRT site. So this will be the acquisition target. And so we'll maintain a buy call with higher DMTP of $0.7. It's trading at forward dividend yield of 6.3%. That's all for me. I'll hand over to Ving for technical costs. Thank you.
Thanks, well, good morning, everyone. I'll move on to the technicals. So first out, review of the S&P front rate last week was up 2.4%. So the key 6,200 support level is still holding, which is a horizontal support level at the start of July. And if you look at the weekly time frame, it's also the 10 MA level. So unless that is breached, I think the current uptrend is still okay. I think we are likely to see some sort of a sideways consolidation going ahead, with the index just kind of trading sideways since the end of July. And also some of the near-term supports will be the short-term moving averages at 6,325 to 6,340. So overall, the main resistance will be likely above, will be around 6,400 to 6,450, and the support will likely be at 6,285 to 6,345 area. So that's all from me. I think Paul is in the meeting right now, so we'll go to the Q&A section first. Thanks.
Yeah, I think, yeah. Let me just take some Q&A first while we wait for Paul. Paul should be tuning in soon, but just let me take some Q&A first before he comes in. Yeah, a lot of questions on the banks, right? So I will just go through one by one. Okay, will DBS outlook continue to be positive with the increase in net interest income to offset lower net interest margins? Will Fed rate cut be headwind with lower CASA going forward? Okay, let me try to understand this question. Yeah, it will be positive, but I don't think it's really just the net interest income that is the positive. There's several factors. So I think the fact that they're able to hold net interest income stable will be positive to offset them. So you are right. And also the fact that they are also growing their fee income quite significantly. Right. I did say earlier, UOB's customers are more prudent, right? 50-60% is still stuck in fixed deposits. Whereas DBS customers, I think they are more they are less risk averse, right? So they are more risk takers, right? So they are more willing to put it into investment products, right? Or to invest or to sign up put a lot of their funds or their fixed deposits with DBS to invest. And then that's how it grows their fixed their fee income. So I guess that would be the main thing for DBS. And yeah, of course, the rate cut could be a headwind for CASA going forward. Paul, do you want to go ahead first, or I continue the Q&A?
Yeah, thanks. I can go ahead. Yeah.
Yeah. Okay.
Yeah.
I
So
hand you over
sorry
to
for
Paul.
the. Yeah. Sorry, everyone, because there was a capital briefing just now on the. It's still ongoing, but anyway, my question has been asked. Yeah. So for Sembcorp Industries, they released the first half results. The title here, wait for payout. What I'm trying to say is that we expect dividends to grow 50%, and they should also be monetizing some assets. Next slide. If you look at the results, the reason why it was below expectations. So why it disappointed and probably why the share price dropped also, because we were expecting, and probably the whole market was expecting, the gas earnings, which is basically the Singapore power business, to actually be growing, because last year there was a shutdown in one of the plants. But instead of growing, it actually came down. So there were a few items. Firstly, there was some one-offs that they didn't mention. I guess lack of transparency on that end. There was also renewal of some contracts that were at lower spreads or lower margins. And also another one that has hit them since December, which of course they didn't mention also, was that they actually were importing energy from Malaysia, renewable energy, but I think they got caught and then the price there was much higher than expected. So this is a 2-year contract. So this will impact them for the next 2 years. The positive was the growth in renewables, which is solar and wind. So the earnings there jumped about 22%, even though China was weak, or actually the earnings came down. And of course, the highlight was the 50% jump in dividends on the left here from 6 cents to 9 cents. The negatives is that, like we mentioned, all the electricity spread and also the one-offs that hit the gas business. In terms of the outlook, we think that they actually kind of hinted that they should maintain this type of growth in their dividends. So we actually raised the payout ratio. And also they mentioned that in India renewables, which is the large part of the earnings, they plan to monetize part of it because they think that it's getting mature, then they can recycle and invest in more renewables. So this could actually pave way for some special dividends. We lower our target price because we trimmed down our net profit because of what mentioned in the gas earnings. Second half, the earnings would be stable. I wouldn't think it would be fantastic, but it would be, I think, stable because renewables half on half might be softer because of seasonality, because second half usually there's less wind and there's less solar, so they will impact the earnings. Next slide. So here we'll just show you some of the things. So in the second half, what will benefit the business will be, as you recall, they acquired 30% in Senoko, then they added another 20% in the first half. So second half, you get that full 50% contribution. So that will help the earnings. But the imported energy that they say in Malaysia, that will also be weighing down. So net, it will be stable. Yeah. Renewables, there is still another 50% of capacity being built. So this will also help drive earnings. Just that the seasonality might make it weaker half on half. But year on year, it will still be a growth. The urban part, they did mention that because of uncertainty over tariffs. So urban means they sell land in Vietnam and also industrial land in Indonesia. So that's the large part of the business. But the earnings expected to be softer because they actually sold Sem Environment. There was a one-off gain of 140 million, but this will actually impact second half a little bit, the earnings. And they mentioned because of the tariffs, the multinational in the industrial parks are less willing to expand and buy land. Next slide. So I will run to venture. So venture is coping under challenging conditions. Next slide. So the results was generally in line the first half, but it's still weak. The earnings is down 9%, and we don't think in second half will be any recovery. So I'm not sure why the share price rallied, but anyway, the strength is that they still have cash. I mean, they are still paying out almost 90% earnings, paying a special dividend, and they have about 1.26 billion of net cash. The negative is consumer lifestyle, which they don't describe, but it's essentially the Philip Morris IQOS heated cigarette. So that's had a 19% drop in revenue for that, for this portfolio. So for that, probably you're talking about maybe 20-30% drop in earnings, in revenue. So that was the one that dragged them down. So we maintain our forecast, but we think there could be downside risk in our earnings. We actually raised our target price to 14 times because I think the market is lifting all stocks. So that's why we lifted it up. In their outlook statement, which they always ask investors to focus on, they shared very little on near-term conditions. But we think second half will remain weak. There will be a replacement cycle of their because what happened is that their IQOS device, the heated cigarette, they actually improved the product. So the life cycle jumped from 1 year to 3 years. So in the past, they had a lot of business because the product only had 1 year, always had problems. Shouldn't say problems, but always had to be exchanged. But then because they extended it, then right now, no, the replacement cycle will be longer. The second thing is actually Trump policies has actually hurt venture a lot. The second thing is because of uncertainty over drug pricing in the US, a lot of the big pharma have been holding back on capex, and of course, venture sells a lot of medical healthcare equipment. The second thing that hurt venture is also because the Trump administration has cut the US research funding grants, so there's also pulled back life science equipment spending. So again, that also impacts venture negatively. And then the fourth reason, which we didn't put up, but actually their major customer, Philip Morris, is also looking to get a new product in the US by waiting FDA approval. Because Trump is also cutting back on FDA, so that approval also being delayed. Yeah, so it's almost like Trump shorted venture stock. Next slide. Next slide. Yeah, so there were some numbers here. Retail sales actually generally quite weak. Actually, the numbers from Singapore retail sales is basically flat. Construction awards also down, but again, it's very volatile number. It can be up 50, down 50, but over the 12 months, construction awarded is up 38%. Next slide. Yeah, in terms of a tactical view, so we actually go through a lot of results, but so just give you some headline comments, which actually Myanmar and Glenn has already mentioned, but let me just read through because this is what we publish in our report. But so for APAC Realty, which is essentially the ERA real estate agency, the earnings jumped almost 3 times. The new launch was just skyrocketed 126%. They might announce a special dividend in the year end. The key thing is that the residential demand has actually spread to of course, the expensive core central region where the prices are almost 3,001, 3,002, where we see take-up rates almost 40 to 60%. And second half earnings should also be strong because second half they will capture the July and August sales. The big launch in August will be the Springleaf Residence, which is apparently a very hot project right now because it's next to MRT near schools and it's selling below 1,009 apparently or 2,000. So that's a hot project. I'm not a real estate agent, but anyway, that's what they said. And the key thing is what is the pipeline for 2026. So 2026, they said the outlook is positive because there are like 10,000 GLS sales for 2026. So that will give them a strong pipeline of new launches in 2026. Sorry, the GLS is 10,000 this year, so this will give the pipeline for 2026. For Riverstone, the most profitable rubber glove probably in the world, what their earnings is actually down 37%. I'll talk about it later, but mainly because of weak US dollar, and we expect another 2 big quarters. For DBS, I think Glenn has mentioned they essentially raised their dividends for 2026. So you're looking at a 6.3% yield by 2026, and also even if you take out the capital returns, you're still looking at 5%. Yeah. And I won't run through all this, but good, just my report, so I just mentioned. But anyway, for us, we think the Yang Zhejiang Shipbuilding share price is up. We are a bit cautious because we think the cycle has peaked. They actually reduced their target from 6 to 4.5 billion orders. Charter rates this year is down 44%, even though in July, the LA said that their container flows are actually at record levels because everyone is trying to jump ahead of the August tariff deadline. Even then, charter rates are down 40%. And there's a lot of ships already on order, like almost close to 30% of the existing fleet. Yeah. In terms of some of the key events to watch would be Wilmar, Singtel, SG Engineering results or update. These are some of the webinars open to anyone. We have Comfort, Takraw, and so forth, Micromechanics. Next slide. So nothing much, just to show the retail sales is basically flat. Construction is still very strong, although it comes out, but I'm not too wary. It's still 38%, and the monthly numbers are very volatile. But in general, you can see there's a big spike in construction activity in Singapore, as we know from all the traffic jams, from all the roadworks. Next slide. Okay, and let me just run through for Riverstone. So Riverstone is a 1 billion. The earnings was first half was down. Basically, the gross margins dropped 27 to 40. The problem is the US dollar. So they used to sell. Let me go to the clean room. So most of their earnings, 70% come from clean room, where they sell their own brand. So that's why they don't compete head on with glove makers like Top Glove, Hata Lega, because this is their own brand. They sell it to clean room makers, are basically like pharmaceutical companies, wafer fab, semiconductor makers. So sorry for the typo here, but so what they give, just to give you an example, they usually sell the clean room gloves at $90, which is a huge number because most healthcare gloves only $20. But because of the ringgit, the strong ringgit, they use what they get now is RM 423 last year, but this year is down 388. So this will impact the earnings. Although in US dollar terms, the selling price didn't change. And also in the US, they should be selling 21 because of all the competition. They're selling to 18 because all the manufacturers in Malaysia dumping to not dumping, they're coming to the US because the Chinese cannot come in with 100% tariffs. Yeah, can you move back to So anyway, so the other reason for the weakness is the Malaysian ringgit. Sorry, the competition from Malaysia. So for us, we expect another 2 quarters of results before 2026 will be a recovery year. So if you look at the table on the left, it's just that the earnings is normalizing back to maybe the 45-50 million per quarter. Because now we're comparing against 2024 really spectacular numbers where ringgit was weak and the prices were still high because of the exit of the Chinese into the US, where they used to make per quarter profit about 70 million. So right now you're just normalizing at 40 million to 50 million per quarter. So that's why we think the next 2 quarters the earnings should be weak. And I think after that, then I think it should stabilize by then. Next slide. Okay, just for the last few slides for me. So we do have our usual monthly. So we do weekly, monthly, quarterly strategy. So for us, let me just go through the Singapore market drivers. So for Singapore, we think the 5 billion EQDP, like I mentioned, it has a meaningful impact on the market. And of course, secondly, in Singapore, there are multiple sectors that are doing well, enjoying strong earnings or drivers. It's basically construction, property. Interest rates in Singapore is actually half, so we begin to see the REITs start to grow their DPU again, their dividends. Of course, the strong Sing dollar, and not just 5 billion, but the GLCs are actually led by the GLCs also returning a lot of capital. Next slide. Let me just rush through this. You have time. So if you look on the left here, so if you look at the 5 billion EQDP, if you take out the STI stocks and in assuming all these funds don't cheat and exclude the REITs, you're talking about almost 4% of the total market cap of all the stocks, which is huge. I mean, and if you free float adjust it, it's almost 10%. So the 5 billion actually has a meaningful impact on the market. On the right here, it's not just the 5 billion by MAS that's coming to the market. DBS is also returning capital through share buyback, Singtel, UOB, and offers capital to a certain extent. So there's still a lot of money being plugged back into the market. So it's not just the 5 billion alone. So that's helping the whole market. Next slide. And this is although we get fixated with the US REITs, actually in Singapore the REITs have collapsed. I think we can see it in our FD rate from 3.6% a year ago to now about 1.8%. This is the 3-month SORA, which is basically the borrowing rate for a lot of corporates. So that's why the REITs also beginning to see interest expense dropping. Next slide. This is just to show there's a lot of liquidity that was mentioned by DBS. They enjoyed record inflows in deposits. So as you can see, the table on the right here, in pre-pandemic, our foreign reserves was basically flat, the +8 -8. But this year so far, we already received 26 billion, which is higher than the 20 billion the whole of last year. If you add in the amount transferred to GIC, you're talking about almost 37 billion. Next slide. Although the market has rallied, but we're still trading at average level. Next slide. And in terms of dividend yields, the spread, that means what you're getting dividend yield of 5% compared to what you're getting from a 10-year bond or your Singapore savings bonds. The Singapore market is exceptionally attractive in terms of the dividend yield part. Yeah. Okay, I think.
Yeah, Paul, I think you hung a bit, but yeah, I think we're going to Q&A. Yeah, so I'll just continue with the Q&A. I think, yeah, quite a few questions for me. Yeah, there's one here from asking why did UOB increase the general provision? I don't know, they didn't increase this quarter at least. If you look at it in the whole, I think you might be looking at the first half figures. Yeah, first half is they raised their general provisions, mainly all coming from the first quarter of this year. The reason being that they in the first quarter of this year, actually all the banks raised their general provisions because they were putting on more overlay, right, management overlay. But I think they realized that they can't really keep doing that in the second quarter because firstly, they never really used it, and then secondly, also they already have such a big overlay to begin with, and then thirdly, also the earnings were not were lower than expected. So if they just put on even more general provisions, then the earnings will decline even further. Yeah, so I think this one you're looking at the first half figures, not the second quarter figures. Yeah, this is quite a long question here from Ian. Looks like DBS is counting on majority of ultra-conservative savers to continue to deposit into their saving FD accounts, so DBS can use it to recycle for loans, fund dividend payout. In essence, these savers are the actual bankers for DBS. Thoughts? It's sort of true, I guess, but I don't think that they're really using it to recycle for loans or the fund dividend payout. I think when fund dividend payout, I think you're talking about their capital returns. Yeah, the capital returns is coming from their excess capital that they already had, right? Even before this huge surge in the deposits that they were enjoyed. What they're doing, I don't think it's the ultra conservative savers. It's from what we deduce is that a lot of this money is coming from they're exiting from, let's say, the US or Hong Kong, and then they're coming in from overseas, then they're coming into Singapore. That's why you get this inflow, like what Paul mentioned earlier. So these inflows, the thing that DBS is able to capture really is because they are the largest bank, right? And also because they also backed by everyone knows who. So that's the reason why a lot of these deposits, they've just flow to DBS. Because when you come to Singapore and you say you're not very familiar and you want to put your money somewhere, you will put it in the largest Singapore bank, right, which would be DBS. That's why they are I think that's one of the reasons why they said, there were questions asked how is it that you're doing so much better than the other two, and then they said it's basically, it's their size as well as they also talk about like tech capabilities, their app, and everything. Yeah, so I think on overall that's the main reason. And they're not just keeping this as deposits, right? They're trying to convert it into AUM, into fee income, right? Into wealth management income. Yeah. So yeah, but maybe the last point, yeah, is quite true. That these savers maybe the actual bankers for DBS, at least for now, right? Yeah, one more here from Ian. Will UOB face more headwinds with more defaults since their exposure mainly to SMEs in ASEAN, especially if tariffs impacting the manufacturers exporter in ASEAN? Yeah, this also linked to another question here, which I'll answer together. DBS wrote back 17 million in GP and allowance is around 130. UOB with loan assets around 25% less than DBS made more than 200 in GP. Is there something wrong here? Yeah, first to clarify, they didn't make more than 200 million in GP. I think you're talking about more than 200 in total allowances. Right, the GP is actually quite low this quarter. Yeah, but when you're comparing the loan sizes, yeah, it will be a bit like confused because why DBS so much more loans, right? The loan book so much larger, UOB's one is so much smaller. Why is their allowances higher? There are many factors. I think the main one being that UOB's customers a lot of them are SMEs, right? So that links back to the first question as well. A lot of them are in SME sector. A lot of them are in the region as well, which are harder hit by the tariffs. DBS on the other hand, it's more large corporates. They are also, which is why they are and MNCs, right? Which is why they're less affected and lesser allowances in general. And UOB doesn't really say how much general provisions that they have, right? But I think it'll be significantly lesser than management overlay they have, but it'll be significantly lesser than I guess DBS's, which is what they said they have maintained it at 2.6 billion. So that could be another factor as well. Yeah, so not that there's anything wrong. It's really, their loan portfolio, their region that they're in, their customer base and everything. Yeah. And also that UOB is a lot more when it comes to the way that they grade different assets and loans, right? They are a lot more prudent as compared to DBS, right? So the moment that there's something a little bit amiss, right, they'll straight away park it into general provisions. Yeah, so that's the reason why. And also to answer the first question, will they face more headwinds? Possibly. Yes, there's a big that could be a high possibility where they more headwinds. Maybe not with more defaults, but I guess the loans growth might be slower for them. Provisions could tick up slightly. Yeah, but I think the biggest thing would be that they may not be able to grow their loan book as fast because it's really to a lot of SMEs in ASEAN, which is why they're also pivoting now towards fee income, their retail banking side, right? Private banking side, instead of, really focusing on SME, because SME banking now it's, I guess the growth is stagnating. Sorry, the question jumped. Yeah, there's this one here. I'll try to answer it. If the EQ would drive mid caps to 20x PE, is there a chance they would drive STI component stocks like the banks to mid-teens PE? I don't think it'll be just that factor, right? The banks PE is really based on their earnings, right? So if earnings aren't very positive or healthy, then the PE will remain quite stagnant. So there could be some flow through. Maybe we'll see increase by 1 or 2, but I don't think it'll go up to like mid-teens level, because the earnings for the banks, even DBS, which is the strongest, is also quite flattish, right? We are seeing slight decline for all 3 banks. Yeah, so I think the earnings outlook is more important when you want to see whether, especially for the banks, like where will their PE go, whether or not you'll rise to mid-teens. Yeah, any potential headwind or tailwind to impact SGX earnings going forward? The biggest headwind will be the treasury income. They didn't actually mention it much in their call, right? They hid it somewhere. I mean, like they put the treasury income in somewhere in their financial statement, so we had to dig it out, and then we realized that, oh wow, it's quite a significant decline, right? did I say 17%? Yeah, 17% decline. So to about 10, 15 million. That goes straight to their profit line because their treasury income is basically just a profit, right? There's no expenses on that. Yeah, so I think that would be the biggest headwind. The CFO did try to say, there was a question asked whether or not what is the outlook on treasury income, right, going forward. And they sort of, I guess, answered without answering, saying that it really depends on market conditions, interest rates, movements and everything, which basically says that, with rate cuts coming in, HIBOR, SORA have all declined so sharply that it will be hit even harder in the next half next results. Yeah. But they also said that not all of the places that they're putting in has lower interest rates. So they quoted Japan, for example, saying that I guess that's the only place where interest rates are actually going up slightly. Yeah, but I mean it's a very small portion of it. As for tailwinds, the tailwinds I mentioned earlier during my presentation when I was talking about SGX, it's really their volumes. July figures were very positive. We are seeing July SDAV, the preliminary ones at least go up by 26% year-on-year. So, heightened volatility, I guess SGX has to thank Donald Trump, right, for increasing volatility. That's why we see the volumes going up for SGX. Also, the OTCFX, they are trying to grow it quite fast. A lot of their capex is going into this building out this OTCFX business, and also they are also really managing to control their expenses as well. Yeah, so I guess more tailwinds than headwinds for SGX. Yeah, this is a question here. Perhaps better to buy DBS shares for better returns instead of parking into savings account. All I can say is that you just look at the dividend yield, right? It's giving currently 6.2, 6.3%, right? Yeah, and then you look at your savings account, it's like 3% if you hit all the criteria, right? If not, you get 0.05%, right? Or even a fixed D now is only 2%. Yeah, so I guess but then of course, when you're buying shares, right, especially like DBS shares, there's volatility involved, right? There's a risk that the share price will go down. So yeah, you just have to make your own a decision and speak to your financial advisor on this for your risk profile. Hold on, sorry. Yeah, quite a lot of questions. Yeah, there's one more here. So perhaps yeah, Glenn, so perhaps OCBC is a sweet spot to accumulate in terms of diversification versus the other two banks. The OCBC is also not, it's a bit more, it's also quite gloomy for OCBC, right? We also have a neutral call for OCBC. I don't think it's really a sweet spot, unless you're worried, that DBS might be a bit more overpriced. But then again, right, you're looking at it, a lot of the banks are all quite like dividend plays, right? OCBC, if you ask me in terms of you're looking at dividends alone, right? If for dividend play, right, it's actually the worst because theirs is fully floating. Even their capital returns is also based on the floating, right? 10% and then 50%. So 50 plus 10, if earnings dip by significantly, right, you will see your dividends maybe even drop to like 4% dividend yield, sorry, like 4 or 5%. So that's a bit of a risk on that side. Whereas why we like DBS so much and why I keep saying this is because they have this fixed dividend per share, and also they have committed to increasing it further in 2026. The other two banks, they really never really say anything when you ask them. They say, yeah, if we have room, we will do it. And DBS is like, yeah, we can give you this 24 cents. And then on a side note, if there's more, we will continue with these capital returns. Because looking at their CET1, there are still quite some ways away from actually lowering it to the optimal. So the optimal is slightly lower than the other two banks. The other two banks are looking around 14%. And then DBS one is, I think they are saying 12.5% to 13.5%. So, they even have more room to go down, which is why we still prefer DBS. And also their earnings this quarter, or at least this half, for this year is also quite a bit better because from this deposits growth that they were able to get, or at least benefit from, sorry. Yeah, here, yeah, so someone asked here, is SGX CEO mentioned about the potential acquisitions going forward to expand business and earnings? Yeah, they did. And they're looking at more bolt-on acquisitions, right? During what they mentioned is they didn't say any, like they didn't mention, any specific acquisitions, right? It was more like when asked, then they answered. But it's really they're looking for bolt-on acquisitions. So that is where they will be putting, if you look at their dividend payout ratio, is around 60+%, right? So then when asked why aren't they giving back more, they're saying that they're looking for acquisitions. And acquisitions they're looking at are those bolt-on acquisitions that will be able to help to grow out their business faster. It's not like something that they need to take on and then grow from scratch. So I think that's what they are looking at. So yeah, definitely. I think any company, I know even if you look at other banks, they are also looking. They will definitely look at potential acquisitions going forward, right? If it suits whatever their plan. Yeah, there's one here about the OTC FX. Let me double check this and I'll get back to you. Yeah, okay. I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Yeah, thanks. Let me just take on some if I can see. Yeah. Oh, sorry, my internet. Oh, yeah. Oh, Paul, what is your target price for Keppel now that it has sold M1? Paul, appreciate your comments on Keppel sales of M1 as implications. So actually, they never disclosed separately the earnings for M1, but including interest, actually M1 is loss making. Based on my estimate, is probably around almost 20 million loss making. So they're selling a loss making company because of the debt for almost 985 million, 1 billion. So it's obviously going to be very positive for Keppel. Most likely we have to raise target price because this is much better than our expectations in terms of the valuations. I think the whole market will probably raise it, and they didn't really say much because they just said that they got the best bid for best bid in terms of price and also best bid in terms of their for all stakeholders, including staff. The other thing is that it's not firm yet how much they're going to pay as a special dividend because it's still early and they'll wait until year end because they still could be divesting more assets, but they would most likely they won't pay all the 1 billion of course as dividends, but they will probably pay part of it because some of it will be recycled for other assets and some of it will be to lower debt, but it's definitely a positive. Yeah. Any views on Pacific Radiance and oil and gas sector general, especially counters? Yeah, so for Pacific Radiance, the key thing is they will have 2 CTVs. So for those who don't know, CTVs are those vessels used in Taiwan to move people around when they are installing the offshore wind farms, those big turbines that you see. So they are completing that. So I'm not sure if they are going to sell it or they're going to operate it. But I think that has so that will be the big earnings catalyst for them. And yeah, but chartering rates are still rising. If the last time I checked at least. Please comment on Sembcorp. Is the valuation? Yeah, I think for us we still have a buy on Sembcorp Industries. Of course, the results was disappointing, especially the transparency. They didn't say a lot of the one-offs. All these bad news, they just keep quiet. But anyway, I think the dividends will be the one that will put interest. But the problem is that Sembcorp only release results in the year and they need to do every 6 months. So the only thing that can move the share price is one thing we will monitor and try and give updates every month will be the electricity prices. It's very hard to capture the spread, but if you look at the USEP price, if that is climbing up, that generally helps the spreads. So I think the last this year, I think the spreads, that means the margin for Singapore electricity has been down, so that's been hit. The second thing to watch is if them selling any Indian renewable business. So between that, I don't think there'll be any share capitalist until the year end. So that's the worry. Yeah. But it is still cheap for us because it's only like 6-7 times EV EBITDA, and their ROE is about 19-20%. Yeah, 2026 will be a stronger year because they will have a new power plant. But for us, Keppel will be the better play for near-term outlook. What's the outlook of Keppel? Yeah, it's going to be positive for them because M1 is technically on paper a loss-making company. Because they have debt attached to M1. So if you add that in, it's a loss-making. So obviously you sell a loss-making company for 1 billion is positive. With Sembcorp performing badly in gas recently announced, has the target price for it decreased? Yeah, we actually decreased. Of course, the market has a much more bleaker outlook. But for us, we are not. If not for the dividends, we might have been a bit more aggressive in terms of our outlook. Yeah, that's why it caught everyone really. Yeah, we thought the earnings should have been strong because they shut the plant last year, so we thought the earnings would recover. Yeah. From your briefing, can I say the second half financial Sembcorp will be undersing? I think it won't be a really blockbuster growth. There would because the reason why I hesitate is there are some plus and minuses. The plus is the renewables will still do well because the capacity jump. So year on year, you still benefit. And then Sembcorp will also benefit, and then gas will also benefit because they have the whole Senoko business. So it will still be a growth in the second half. Just that after what happened, we are not sure if they got any hidden things they didn't disclose, or to be blunt about it. But we still think second half on balance should be positive because the renewable capacity grew about 30-40%, so that will benefit. Yeah. It's just that but this is something we have to monitor, and so for us, Sembcorp is still attractive, despite the disappointment. Yeah, in a nutshell. Grateful if you can put the slide for Sembcorp. Yeah. Can someone put the slide up for Sembcorp for the gentleman or lady? Yeah, thanks. Do you have the electricity price chart to explain? Yeah, okay. The issue is not just the electricity. So what I have to do, which I did last time, but I didn't really monitor, is that I have to take the electricity price and the cost of electricity. So the cost of electricity comes from LNG and comes from piped natural gas. It's not just the absolute price, you got to look at the spread. So for that, you have to peg it against all price, or the USEP, against HSFO, high sulfur fuel oil. So let me do one chart so that I can better monitor it. Yeah, because I did it last time as well, but I didn't because I thought that it would be stable. But yeah. Let me try to do it because it's not so simple as just the electricity selling price. You also have to look at the cost, which is now make it more complicated because they have LNG and also piped natural gas, which has been all along the source for Singapore. Yeah, for Wilmar, yeah, we don't think Wilmar's numbers will be strong, but based on all the indicators that we looked at, sugar price is down, palm oil a bit more stable, consumer market is not strong, and then the soybean crush I think will be weak. So we're not expecting any strong numbers from it. What is the outlook for telcos? Will Simba take more market share, or will they increase fee from M1? Actually, we're not sure. To be fair, if I had to guess, because all this depends on the individual. If I had to guess, I think Simba will go for market share. I think they being the third operator now, they may not have enough subscribers because in this business you need economies of scale. So I think they might want to try to raise the number of subscribers they have so that they can scale up better against StarHub and Singtel. So one way to view it is that if StarHub would have acquired it, they would have already big enough scale. I mean, they may not want to go and fight on price anymore, and then because of that, then maybe they will tone down. But for Simba, one argument you can say is that they are the smallest among the three, and the scale may not be big enough, so they might. But the other counter argument is that you might not want to do a price competition when you're doing an integration like this. It makes it very complicated. Because at the same time, your team is integrating the two businesses, and then at the same time, you're fighting for market share. So that's why I don't really have a hard number for you. But all I can say is that some telcos tell me that even at $10, the price, it looks expensive because the prices have really come off a lot. So for me, I will still be cautious. That's why we have a neutral outlook. The winner is Keppel, so that's a very easy way to analyze this. Still unknown. We're not sure how the competition reacts. So this one is more like behavior rather than some rational thing. So we're not sure what will Simba do because it's yeah, they could also be irrational and still fight for competition because they want the scale. So that's why I don't really have a firm answer for you. But regardless, I mean, we still have a neutral for StarHub because of the competition out there. Yeah, I'll leave it to Darren for the developer question. Yeah, thanks.
Yeah, I'll just answer the developer question. But not recently, has anything changed fundamentally? Yeah, so first of all, definitely the interest rates, like we see the home loans, a lot of it is if it's a floating portion is tagged to the 3-month SORA. And as we all know, the 3-month SORA is now under 1.6, 1.7 is like half from last 1 year ago. So that is one of the key drivers also, the low interest rates, and also the demand for the recent launches is very high. And even in the CCR, like Paul mentioned earlier, it's also quite strong, like 40%, 50% sell-through rate. So all these are really tailwinds for the property sector. So as a result, we've seen a lot of these share prices rise, and the discount to the RNAV has narrowed basically for a lot of these REITs as well. Sorry, not REITs, for the developers as well. Yeah, so you see CDR now is trading $6 plus. So that is now about a 30% discount to their NAV that they disclosed based on book of about $10. Yeah, so yeah, the developers basically generally all are facing this tailwind from low interest rates and very strong local demand. Yeah, demand still mostly from Singaporeans and PR still, right? But mostly still Singaporeans. Yeah, and also HDB upgraders. Yeah, as the price gaps narrows. Yeah, so hope that answers that. Yeah, if there are no more, actually hand it over to Zane for the TA. Yeah, we have some more. What is the expected city dev results? Yeah, so results we're expecting good sell-through rate as usual, like from both existing projects as well as those the pipeline. So, like for instance, the Ori has sold almost over 90%. So we're expecting that to flow through to the financials. So we're expecting some decent results, and yeah, for the full year also, yeah, as a portfolio, they are performing, that they are improving, especially the property development sector, like as I spoke about it earlier, and the hospitality sector also remains fairly resilient. Investment side, slight headwinds from China, but other than that, still doing relatively resilient as well. Yeah. What is AIM's Apex NAV? Yeah, that is $1.23.
CDR might announce special, is it? Because of the sale gain on sale.
They might, yeah, but that is not it's not confirmed up yet. So it is a possibility. Yeah, the sale of the South Beach. Yeah. Yeah, thanks. Hand over to Paul
Ye-
was
Yeah,
saying, yeah,
let me
thanks.
just answer some. So any downgrade on target price? Yeah, we think I mean, I downgraded my target price. So we do think that other houses will also downgrade because I think the results definitely below most of the other. I don't have the number of me, but I believe it has been also below other houses' expectations. Because I think everyone has a buy on Sembcorp Industries. Yeah. What can we expect for ComfortDelGro's upcoming results this week? We expect it to remain strong, purely because of the UK business. So the whole repricing of the UK bus routes, where they are getting used to be 1 or 2% margin to maybe low teens or mid-teens margin, that is like a 3 to 4 year event. So that will help pull the results. Yeah, and also there are some acquisitions last year, so the earnings should be stronger. But again, no, after what happened, yeah, hopefully they execute according to plan. For that, we cannot predict how the company executes. But we think the earnings should be strong. Strong means at least mid-teens kind of growth. Yeah. What's pushing up PropNext share price recently? I think the share price up because of the APAC relatively strong results. The thing to watch is also how the launch of Springleaf Residence, because that will be the last big launch. I think it's 900 over units. I don't have the exact number, but that will be the last big launch before Hungry Ghost Festival. So, and I think that you should expect a very strong take-up rate for that. So that will help carry the stock even after PropNext results comes out, which is coming out tomorrow. Yeah. Oh, sorry, yeah, coming out tomorrow or maybe today after market. Yeah, but definitely will be out by tomorrow morning. Is Young Lot valuation? Yeah, sorry, I don't have the valuation of that. Yeah, they are doing a briefing, so maybe we can give you a Phillip on the ground after that. Yeah, thanks for that. Yeah, so sorry, I don't have the number for you here. Hand it over to Meow Meow and yeah. Can you give your latest view on Yoma after AGM? Any chance to have a corporate? Yeah. Thanks for the suggestion. Yeah, I would ask them again. Yeah, sometimes we forget. Yeah, I will send them a note and ask them for Phillip on the ground. Yeah, thanks for the suggestion. But latest view, I didn't go for the AGM because I too many meetings. But I think the one positive is that it seems to be an election is going to happen in Myanmar. Yeah. But let me get back to you. I'll try and invite them. Yeah, thanks for that. Yeah, I hand it over to the rest.
Yeah, hi. So Yang Zijiang proposed to spin off the Maritime Investment Fund into a new entity. Yes, so to be listed afterwards. And we believe this will help to unlock its value. Yeah, so potentially may improve its price to book. Yeah, hope it answers your question. I'll hand over to Ben. Thank you.
Thanks, Mel. I'll move on to the technicals. Yeah, so hopefully my screen is showing. Yeah, okay. Yeah, so first one to talk about is Sembcorp Industries. So for Sembcorp, there's a question, is it oversold? Yeah, definitely. Now, if you look at RSI, it's 27. So I think for now, in terms of the chart wise, actually today it broke down this the main uptrend channel it was trading in above lah. So I think for now the next supports the key support definitely be closer to about $6. That will be a psychological level, as well as on the daily time frame is the 200 MA as well. So on the weekly the around $6 there will probably be a good support as well, I think, because there will be the 50 MA on the weekly. So previously in a few occasions where the stock has pulled back, I think in the past 2 years there has been a very strong support where we touch this orange line over here. So I think that if the stock reaches there, that will be a very good support. Yeah. Then for now, it's just wait for the momentum to just come off a bit first. If the stock does trade a bit sideways afterwards, then there's not much should be not much selling pressure after that. Yeah. Okay, I'll move on. I'll talk about some of the other counters. First one on APAC Realty. Yeah, so for APAC Realty, definitely just trend continuation after the earnings today. We saw a gap up. Price continue to hold up well around 70 cents. So I think for here it's a bit of a level, but I think we should be able to see a higher high above that. The next key level I think would be around somewhere like 77 cents. And that's probably the next key level. Then I think price will, if there's some pullbacks on the way, I think price will going to find some support on the 5 MA right now because of the strong momentum. Then next one is on iFast. And so for iFast, I think price is very strong. You can see that it's still holding along the 5 MA. So the current support is around $9.30, which is so like a bit of a horizontal resistance over here that's actually turning the support. So I think we might see a bit of a sideways consolidation, but I think momentum is still pretty strong as long as it holds the 5 as well as 10 MA, currently at 9.08 as well as $9.30. And the next key resistance, I think, will be around 977, about there. Somewhere closer to 980. And for ST Engineering, I think right now it's I think it's just repeating what it's been doing most of the time. It's just a very steady uptrend. And then whenever it touched the trendline resistance, price out just consolidating sideways. So I think we're just seeing some sideways consolidation before the results. Yeah, it's currently just between about 840, around 865, then the resistance, some resistance around 895 around there. Yeah, those are some sideways consolidation. Okay, then there's a question on Comfort that will grow. And so for Comfort, I think it's still a very gradual uptrend. So it's generally trending within this ascending broadening wedge. Then recent price action, some pullback after a very strong rally, but still finding support at 153. So that's very good, which was higher resistance. Then you look at some of the short-term movement, which is also just a bit sideways recently, but some support will be around 155 for now. So I think you might see some sideways, but if price can overcome like 157, I think we could see some further rebound towards close to 160 or the recent swing around 164. Still just a pullback towards some of the moving averages, mean reversion. Next one is on Xing Xiong. So yeah, Xing Xiong I think is doing a bit of a sideways, but overall the uptrend is still holding very well. The key trendline support is over here, and support is around this close. The very strong support I think will be around 203 to about 207, this area, which is a previous horizontal resistance breakout, and then we have the test of this swing low over here as well. Then yeah, just probably moving sideways right now first, I guess. Next one for SIA, I think yeah, price is just moving a bit sideways right now. After some selling them, holding some support around 650. Yeah, then I think if price can try to get back above this 660 level, then we might see some rebound towards 670. Yeah, just a bit sideways right now. Next support level I think will be around 640, which previously it was two swing lows for in May as well as June this year. So I think overall might still remain a bit sideways in the near term. Next one is on sets. For sets, I think is just generally quite a bit of sideways right now after the pullback from 337, which is a swing high. Then overall you can see price is just moving sideways about 320, holding as support. Then I think if there's some resistance around 325 right now. So if that can be overcome, then the next resistance will be around 331 to about 338, this level. Okay, then next one is on Fraser Centerpoint Trust. So I think this one is a very ways, but I think the overall trend is still quite good. You still see overall is higher lows along the way, and the key resistance is still holding around 228. But you see higher lows since about 203 and 213, and as well as 217. Currently some support at 220. Yeah, so just moving sideways with some support around 220 to 222. Then resistance will be this 228, 229. And overall, it might look like a bit of an ascending triangle, just very, very sideways in longer run. And next one is on Manulife US REIT. So for Manulife, I think some weakness, right? A bit of a weakness, but overall it's a very sideways kind of range that we've been seeing since start of May. So initially price broke out above this 0.065 level. We did a bit of a range sideways, double top. Then some weakness is it broke below the 0.065 level again, as well as holding below some of the short-term movement averages. So I think for now, we most likely just see some range, but in a lower range between like 0.060 to 0.065, where this was the previous horizontal support previously as well. Next one, there's a question on Golden Agri. Yeah, for Golden Agri, I think this counter generally nothing much is going on. So the key level will be around 26.5 cents to 27 cents level. So previously, you can see this was a quite a strong resistance. And the next key resistance will be around 28.5 cents level. So I think my guess will be sideways over here. Close to 27 cents will be the resistance. Then support will be around like 25 cents about there. So generally very moving sideways actually since the start of this year. Then there's a question on Supermicro Computer, SMCI. So for SMCI, after the results, there was a big gap down over here. And then currently, I think it's testing this for the 5 support level, which was previously this range resistance. But I think we might see some continued weakness going ahead, maybe towards the strongest support level will be somewhere closer to about $38 to $39, which is the lower end of this range. And then this was quite close to a previous range resistance breakout level as well. And then we also have this it could retest this trendline support over here as well. So somewhere closer to about 39 would be strongest support right now. Yeah, then just some bearish price action after the gap. Next one is on SIA Engineering. So for SIA Engineering, I think just a bit weakening in terms of the price action. Before that, price was in a strong uptrend. Then over here, since it broke down below this 317 level, so which is a consolidation wedge over here as well. Price is just moving a bit sideways between about $3 to 317. So just some pullback since late July. Then I think we might see some sideways price action with what $3 as support. Then resistance is coming from as price is trading below the short-term movement ranges, resistance might come around 311 to about 317 for now. On Hong Kong Land, yeah, for Hong Kong Land, I think price is just kind of moving sideways. I think the price is still holding this very key support, this upward trendline support over here. Then some weakness recently where we see the breakdown of this range around 620 with the increased volume as well, but still finding some support from a lower support level around 585. And it's just hovering around this 620 level again. So I think if as long as price can hold this trendline support, that's around $6. I think we should be able to see some more sideways consolidation. It will be better if price can get back above 620, then the next result will be around 640 level again. So I think short term, I think probably just kind of consolidation sideways first. Okay, then I'll talk about the 3 local banks. So first out on DBS, definitely still very strong all-time highs right now. And after the results broke above this 49.20 level. So in the short term wise, I think should be able to find some support along these 5 MA right now. It's currently around 49.60 about there. So I think price will still remain having some strong momentum right now. As for the others, first one UOB, I think we're seeing some weakness after this was an earnings gap down over here, and currently finding some resistance around 36 to 36.20, where this is in terms of the horizontal level, this was previous resistance, then there's support, and there was a breakdown of the support, so now it's a resistance, and also this downwards resistance line as well, and the short-term movement, which is a 510 MA. So I think we might see price continue to pull back for a bit in the short term. Then the next key support will be somewhere close to 35 if it reaches there. 35 was a previous horizontal support level. And as for OCBC, I think it's probably remaining a bit sideways in the short term. So after earnings, there was a retest of this around 16.45 level, previous Shanghai recent as well. Then price is just rebounded from there, and there should be some recent go to 17. So I think in the short term, probably it's a bit sideways. Okay, then there's a good question. For Centurion, there's a question. There's an MACD divergence on a daily chart. Could it be a signal that the share price may have peaked and is reversing downwards soon? Yeah, so I agree. There's a divergence on the daily on the MACD on the daily chart, because previously I think this because previously price was just in a very steady uptrend. Then as price kind of turned sideways recently since mid-July, that's why you see the moment, because MACD is tracking the momentum, then it's coming off right now. But you can see all this, I think since quite long ago, about last year, price has always remained above the MACD zero line. So that's still a very strong momentum. It's just in the near term wise that some momentum coming off. I don't think the price has peaked right now. It's probably just consolidating sideways. And if you look at some of the other moving averages, like the 50-day, if it touches there, I think it's quite a strong support whenever price kind of does sideways movement. For example, in December and March this year, the 50 MA has acted as a bit of support when price moves sideways. And during the Liberation Day sell off in start of April, that also acted as support. So currently, I think we could see some support around the 160s, 160 to 165, this area. Yeah, so my take is probably not peak yet, just consolidating sideways after a strong rally previously. I see there's a question on Berkshire Hathaway. Yeah, so for Berkshire, I think right now the price is still showing some weakness. Really, there was just a steady trending lower. Then recently, price was a breakdown below this 470 level that's still finding resistance. So I think the trend in sort of short term wise is still continuing to pull back. Then some of the next support levels for now 455, and then after next one will be 440. Yeah, so and then I think for the short term wise, we probably just continue to see some bit of a pullback, because unless it can try to break out above this downwards resistance line and also try to reclaim above 470, then we might see some recovery for Berkshire. Okay, then I see there's a question on Ethereum as well as Bitcoin rally recently. So first one for Bitcoin, I think should be still quite positive, because in terms of the price action, I think about last week, we retested around 112K, which was the previous all-time high, then continue to find support. And look at some of the recent price action managed to recover back above this 116,000 level, where it was just consolidating sideways. And it's back above some of the short-term moving averages. So most likely could continue to retest this 123 all-time high, then maybe just move a bit sideways again. On the weekly itself, on the weekly chart, continue to just find some supports around the 10 MA, which is a very strong support level. So just slowly trending upwards. As for Ethereum, it's also still continue on the strong trend. But here on the weekly itself, can see is since start of July, price has been finding support along the 5 MA level. So it's currently around 3,940 right now. And also broke above around 4,090 resistance level as well. So I think most likely we should be able to see the upwards momentum continue on. The next key resistance level, I think I will put it around somewhere close to 4,450. And then will be somewhere close to the previous all-time close to 4,800 to 4,900. Yeah, so I think still a strong trend as long as continue maintains above 3,060 to and then the 4,000 level as well. Oh, okay, then see some other questions will be there's SGX. So for SGX, I think overall it has been trending within this uptrend channel itself. Then some probably is a bit of a sideways kind of price action over here right now first. Yeah, where support is probably around $15.60 and just moving sideways. Because there's some resistance about like 16.20 about that. The next one is Wilma. I think nothing much is happening right now. So just very range bound whenever it comes to about 290, there's some support. The next level is around 280 as well. Then whenever it's around $3, there's some resistance. So probably I think it's quite sideways for Wilma still. And for Mapletree Lock, also a bit sideways remaining. With there's still some resistance around $1.18, which is a key level. Then afterwards, the next, if you can break out of that, the next key level I think will be somewhere like 123, 124. Yeah. So, but the positive thing is that higher lows have been formed already. So previously like 107 and now it's like 111. So just probably still consider sideways, but I think in the future that could be as long as it maintains this series of higher lows. Yeah. For Mapletree Industrial, I think it's moving a bit sideways. Sideways for now with the resistance zone is around 203 to 206. Then support is about 196 to about 198 area. So just kind of just trading sideways. But similarly, there's also higher lows if you since April this year. So probably just consolidate sideways. Then for the next time you can break above this 204, 205, then we might see then test the next recent about somewhere close to 210. And next one is on city development, CDL. I think CDL looks a bit it looks like it's moving a bit sideways right now, but the trend is definitely still very strong right now. Still very strong. Yeah, some support probably right now will be around like 625 or there, then resistance around 645. So just moving sideways, you can try to break above this resistance. I think the next resistance outwards will be somewhere close to about 670 as the next key level. For Yenlo, I think a bit moving sideways. So yeah, for some pullback from this 63 cents, this horizontal resistance, then price, but still holding some support around, I would say 55 cents to 56 cents. This area will be some support where there was a swing high previously. And also there was a bit of consolidation area over here. And this uptrend support line here as well. So probably I think we'll find some rebound over here soon. Next one, there's a question, is Zixing still a buy? Yeah, there's some bit of a pullback recently. So I think probably quite sideways. I think it's probably it's a buy. I think it's a technical buy, probably somewhere close to this support area again, 0.028, 0.029. Previously this was like there was a resistance over here, and then price broke out from here. And then previously when price showed some weakness at the end of June, it also touched the 0.029 level, then before some rebound. So I think probably here it's more towards a technical buy. Then but probably there will be some resistance at 0.031, 0.032 these levels. Yeah, so generally still very range bound. Yeah, I'll try to take about 2 more questions. So please comment on Seatrium technicals. Does it look like overall further seem to be stuck in 230s? Yeah, for Seatrium, I think after the earnings, there was a bit of a sell down over here, but still maintaining this 227, this 20 MA. If you look at the short term moving average, still finding some support over there. So I think probably a bit sideways right now. As long as it can hold this 235 level, which is this key, it's a key horizontal level, as well as the short-term moving averages, then we might see price try to recover towards 245 this recent gain. So I think it's a bit sideways right now first. Then for YZJ Shipbuilding, I think looking at the chart. And looking at the chart after the earnings, there was a big spike. Then a bit of resistance around 292 right now. 292 was previous, a bit of a horizontal resistance back then. So I think we might see a bit of a sideways consolidation first. Then I think price will find some support along the 5 MA, as well as this swing low on Friday, which is around 280. So maybe some sideways consolidation first, then afterwards, if you can try to break out again, then we might see this upwards momentum continue up to test about 315, about that's the next resistance. Okay, yeah, I still see some questions on TA, but sorry, I'm unable to take all of them in view of time. Feel free to post inside our Podium Street community on TA. Now I'll try to answer over there. Yeah, but thanks for all your questions. I'll hand over time back to Paul if you have any more questions to answer. Thanks.
Yeah, thanks everyone. Yeah, there's some questions we 15% tax rate on AMD, and yeah, we need to wait for Yitban. I'm not sure because I don't have the answer for that. Any outlook for Singpost? There isn't anything interesting coming up for Singpost for us. I think we mentioned it before. I think the sale of the mall is probably going to be at best next year. Restructuring of the postal network will be the one to look out for, but they'll be highlighted with the new ministries and so forth. I think it will probably be the year-end event. And then the underlying postal operations is not going to be performing. So in the very near term, we just don't think there's much to help the share price. I mean, yeah. Okay, I think, yeah, thanks everyone. I already crossed 1 PM. So thanks everyone for your time and especially your questions. Feel free to just type in questions in our community if we didn't answer. Yeah, take care everybody. Bye-bye.